Check. Sound check. Check. Good evening, students. Welcome back to one more revision lecture for your CA final AFM. And today we'll be doing derivative analysis and valuation. Okay. So let's get started now. So, my dear students, this, as you all are aware, is one of the most scariest chapters for CA final students. But be with me, solve with me, revise with me, and I'm very sure that you are going to enjoy this particular chapter a lot. Basically, derivative analysis and valuation, I'm going to divide it into three main parts. The first part will be revising today pertaining to your futures, and it is very, very, very comprehensive. We'll be visiting each and every concept, each and every question. Only if it's repetitive, then you all can practice it on your own. But wherever I feel that there is a need, we will be definitely solving all those questions. Okay. So I hope you all are ready with your notebook and your calci as well. Because as you all know, what is our practice of revision is that we are going to revise just not by seeing the particular questions, but wherever there is a need to practice, then we can practice those particular questions as well. Okay. So it's going to be super amazing and very comprehensive. Also, all the formulas, etc. I'll be writing it down on the screen. You all can copy it down. But the objective of today is to complete your futures part. Okay, so just be with me throughout the entire video because you all know that derivative analysis and valuation is a very lengthy chapter. So again, I'm repeating, we'll be dividing this into three main parts. The first part which we'll be doing today, that is your futures. Second, tomorrow we'll be doing options. And then there will be option strategies, valuation, arbitrage, all those things we'll be doing it on the third part. Okay. So first of all, uh, let's start with the very basic of what is the meaning of the word derivative. Okay. Now, whenever I talk about derivatives, you all are aware about the fact that derivatives means it's a financial contract, and the price of this is not dependent on its own, but it is dependent on some underlying asset. So derivative is a financial instrument, the price of which is derived on some underlying asset, right? So when I'm talking about underlying asset, what types of underlying assets can there be? So derivative financial contracts basically deals with commodities, it deals with your it deals with your stock, then it deals with your index. So we are going to learn how to value these kind of your underlying asset. Okay. So my dear students, derivatives, the price of which is based on some underlying asset, and there can be different types of derivatives financial contracts which deals with your commodities, then it deals with your stocks, it deals with your indices or index. Okay. So in this chapter, we are going to learn in the first part, how are we going to estimate your future price of an equity share? Okay. Or what is the future price of a particular contract? Okay. So it can be future price of a commodity also, it can be future price of an equity share also, it can be future price of an index as well. Okay. So basically, what should be your approach towards calculation of this future price? We're going to start with the very basic. Okay. So let us first understand that whenever a future price or a forward price needs to be calculated, always think from the seller's perspective. Okay. So let's say, for example, if you have 1 kg rice with you, okay, and I want to purchase that 1 kg rice from you after the period of 1 year. So then the price which will be quoted for that 1 kg rice will be obviously from the seller, right? So we always have to think from the seller's perspective, right? So what should be the price of that 1 kg rice? So when a seller is going to determine the price of the particular commodity, it will take into consideration so many things, right? So let's say, for example, the spot prices 1 kg rice is equal to, let's say, rupees 10. Okay. Now, if I want to buy this particular rice from you after the period of 1 year, you are the seller of this rice. So what will you tell me immediately? Sir, if you want to buy this rice after the period of 1 year, then my money is actually getting blocked for the period of 1 year. So there will be definitely some interest cost which will be added to this 10 rupees. So had it been this particular rice would have been sold immediately, then 10 rupees would have been received by the seller immediately. Come on, yes or no? Of course, yes. But if suppose this 1 kg rice, I am purchasing it from you after the period of 1 year. So for the period of 1 year, the seller will think like this, that the money is actually getting blocked. So will the seller charge interest on the same? Come on, yes or no? Then the answer is yes. So that is why whenever we are determining a future price, then we always have to think from the seller's perspective. Okay, yes, there will be some interest cost which will also be added to this particular spot price. So ideally, when we are calculating, let's say, a 12-month future, this 12-month future will be nothing but what? It will be spot into 1 plus whatever is the interest rate raised to the power n minus and plus whatever is your storage cost. So we have to take into consideration the storage cost as well. Now, what is the storage cost? I'll explain this to you. But first of all, my dear students, are we going to take into consideration the interest element also? Come on, yes or no? Then the answer is absolutely yes. Okay. So it's a very simple concept, that if suppose I want to purchase from you this 1 kg rice after the period of 1 year, then a seller will think like this: if this 10 rupees would have been received by me today, then I would have invested somewhere else and earned interest on the same. But if suppose sir is making the payment after the period of 1 year, so for the purpose of determining the future price, what should I do? I should definitely take into consideration the interest part. Okay. So that is why it will be spot into 1 plus I raised to the power n and plus your storage cost. Now, what are the storage cost? Now, let's say, for example, you are the seller of rice and you tell me, sir, if you want to purchase this rice after the period of 1 year, then I need to, store this particular rice for the period of 1 year. Come on, yes or no? Yes. So if I need to store this rice for the period of 1 year, I need to bear some warehousing charges. Now, this warehousing charges, I'm going to bear it from me, from my own pocket. So I will charge it from you. So when this future price is determined, of course, this storage cost should also be added to the price of the particular product. Yes or no? Yes. But it all depends on when this particular storage cost needs to be paid. Whether the storage cost is paid either at the beginning or at the middle or at the end of the particular contract. Now, let's say, for example, storage cost is paid at the end of the contract. So you are the seller, you tell me, sir, this storage cost I'm going to anyway pay at the end. So that is why my money is not getting blocked today. So let's say, for example, 10 rupees is the spot price for 1 kg of rice. and the rate of interest is, let's say, for example, 10%. So we will add 10% to it, and plus the storage cost. So storage cost, let's say, for example, you tell me, sir, I'm going to pay 5 rupees per kg as storage cost. So basically now what will be the price of this 1 kg rice in a 12-month future market? So this is now going to be 11 plus 5, and that's going to be 16 rupees. Come on, yes or no? Yes, sir. So this will be the price of 1 kg rice in your future market. Also at the same time, my dear students, if suppose this storage cost is paid by the seller at the beginning. Now, when it is paid at the beginning, now what will you argue as a seller is, okay, sir, this 5 rupees is also now getting blocked for the period of 1 year. So that is why when I will be quoting you the future price, I will not only take the spot price and the interest element on it, but also the storage cost and the interest element on it. So that is why, my dear students, this 12-month future price in that particular case will be calculated by taking the price of this spot 1 kg rice plus whatever is 5 rupees, that is nothing but your storage cost which is being paid at the beginning, and then to this I will be adding 1 plus interest cost raised to the power n. So my dear students, in this particular case it will be 15, and to that I will be adding the interest of 10%. So in this particular case the answer for this will be 15 plus 10% or 15 into 1.1 whatever. So this will eventually give you 16.5. So is this price of your 1 kg rice in the futures market when the storage cost is paid at the starting of the year? Come on, yes or no? Yes, because interest cost should also be added. So it's a very simple concept that if you think from the seller's perspective what quote needs to be given, then what will come to your mind is, okay, sir, first of all, spot and whatever is the interest, we have to take that into consideration. And then the storage cost, whether it is paid at the end, we will add it directly. And if it is paid at the beginning of the contract, then we have to also add the interest element to it, thinking that the storage cost is also getting blocked of the seller for the entire year. But what if, my dear students, if suppose this storage cost is paid somewhere in the middle? Now, in this particular case, as you all know, if it is paid in the middle, then we have to first bring this to the present value terms and then add what is going to be the interest part. So, my dear students, what we will do in this particular case is, we will take the spot and then we will add the present value of the storage cost, and then the entire thing we will be taking into consideration into 1 plus I raised to the power n. Now, what do I do by when we are considering this? So what is the basic objective? Let's say, for example, it's a 12-month contract. Okay. Okay. So if the storage cost is paid at the end, there is nothing to worry. There is no money which is getting blocked. So no interest on the storage cost. If it is paid at the beginning of the year, of course, there will be some type of the interest cost which will be added to it. Yes or no? Yes, sir. But if it is paid somewhere in the middle, so let's say, for example, we are paying storage cost, let's say at the end of 6 months, then what we will do in this particular case, we will first bring this into the present value terms, and then we will add the interest for the entire year. So this will ease your calculations whenever there is storage cost which is paid somewhere in between of the entire contract. So if the storage cost is paid, let's say, for example, at the end of the third month in a 12-month contract, then what you should do is, you should first bring this to the present value terms, and then, my dear students, charge the entire interest for the full year. So that is how we can now actually calculate your price of the commodity. Okay. So when I'm talking about derivatives, again, I'm repeating that derivative is nothing but the financial contract, the price of which is based on some underlying asset. So whenever, my dear students, we are talking about underlying asset, what are the types of underlying asset? The first underlying asset which we are discussing is commodities. So when we are pricing for commodities, there are three formulas which are possible. What are the three formulas for the same? So your future price will be spot into 1 plus I raised to the power n, and plus whatever is the storage cost, we will take that into consideration. And this is when the storage cost is paid at end. Then your second formula will be, your future price is nothing but what? It is nothing but spot plus whatever is your storage cost into 1 plus I raised to the power n. This is when the storage cost is at the beginning. And then, my dear students, the third case is my future will be spot plus whatever is your present value of storage cost. We will take 1 plus I raised to the power n when your storage cost is somewhere paid at the middle. So on this basis, my dear students, we can actually calculate what can be your future price, which can be calculated with the help of these three formulas when the storage cost has been paid. Okay. Now, my dear students, if you're talking about, sir, what is this raised to n? So raised to n, as you all are aware, deals with actually your power of compounding, right? So what is this raised to n? Raised to n is nothing but your power of compounding. Now, this power of compounding, how should we take it into consideration? Now, let's just discuss something about this. So here there is no need to be confused at all. Why? Because now we are going to just summarize this in the best possible way. See, my dear students, let's say for example, if it's a 12-month contract, okay, so I'm talking about a 12-month contract, okay, and if suppose the interest rates are compounded on annual basis. Now when the interest rates are compounded on annual basis, what do I mean by this is that the interest on interest will be charged after the end of year one. Now, anyway, my dear students, it's a 12-month contract. If it's a 12-month contract and if the compounding is happening on annual basis, so the first compounding effect will take place after the end of the first year. So in this particular case, my dear students, is there any need for any raised to the power n for this particular type of a question? Yes or no? Then the answer is no. Why? Because the compounding is not going to take place at all. Why? Because it's a 12-month contract. And if it's a 12-month contract and the first compounding take place after the end of the first year, so there is no need to raise to the power n. So that is not going to be possible. But let's say, for example, if it's a 12-month contract, okay, so in this particular case, I hope you are trying to understand that there is no compounding which happens. Okay, so there is no compounding which happens when it's a 12-month contract. Now, my dear students, if it's a 12-month contract and also if the compounding is done on annual basis, so then there is no need for any compounding. But if it's a 12-month contract and my dear students, here in this particular case, your compounding happens on semi-annual basis. Oh, now in this particular case, are we going to have the power of compounding impact come on, yes or no? Then the answer is absolutely yes. Why, my dear students? Because if it's a 6-month, if it's a 12-month contract and your compounding happens on semi-annual basis, what do I mean by this is because compounding is now going to happen 2 times in a year. So if there is going to be 2 times in a year, so what is going to be the outcome of this? Can I say here the compounding will happen? Come on, yes or no? Then the answer is yes, because it's on semi-annual basis, so compounding will come. And compounding will be done 2 times in a year because it's a semi-annual contract. I hope you understand what's a semi-annual contract. What is semi-annual compounding? Semi-annual compounding means your compounding will happen now at the end of the first bi-yearly part and the second. So 2 times the compounding will happen. So in this particular case, when we will be calculating your future price, it will be spot into whatever is 1 plus I, whatever is the rate of interest, which I need to now divide by 2, and then I will raise to the power n into 2. Now, what is your n? N, my dear students, is nothing but the time period of the contract, and 2 is nothing but the number of times the compounding is happening. So in this particular case, my dear students, what is going to be my future price? My future price will be spot into 1 plus I, divide that by 2 and raise to the power n into 2. So basically here my n is 1. So that is why it will be 1 into 2. That is nothing but raised to the power 2. So finally your formula for future will be what? Spot into 1 plus I divide by 2 raised to the power 2. Now, in the same situation, if I tell you that it's a 12-month contract, guys, if it's a 12-month contract and if the compounding is happening on quarterly basis, so how many times in a year the compounding will happen in this entire contract? It will happen 4 times in a year because it's a 12-year contract and the compounding happens 4 times quarterly basis. So in that particular case, will the formula include your power of compounding? Yes or no? Yes. So it will be future is equal to spot into 1 plus I divide by 4 because the compounding will happen 4 times in a year. raised to the power n into 4. So because it's a 12-month contract, this is 1 into 4. So then it will be raised to the power 4. Also at the same time, my dear students, let's say if it's a 12-month compounding which is going to happen. Now for a 12-month compounding, my dear students, as you all know, it's a 12-month contract and compounding happens on monthly basis. So in this particular case, can I say that compounding will happen for 12 times in a year? So what will be the formula for future? It will be spot into what? 1 plus I divide by 12 raised to the power n into 12. So this is how, my dear students, we'll be taking into consideration the power of compounding. Okay. So don't worry, even if you have not understood right now, we'll be definitely doing this again in much more detail when we'll be practicing the questions. But my dear students, I'm just making you understand that when this power of compounding will apply. Okay. So if it's a, let's say, 6-month contract. If it's a 6-month contract, my dear students, if it's a 6-month contract and the compounding happens on annual basis, there is no raise to the n which is possible here. If it's a 6-month contract and compounding happens on semi-annual basis, again there is no compounding effect which will be taken into consideration to calculate your uh, future price. But my dear students, if it's a 6-month contract and if the compounding happens on quarterly basis, then will that 6-month contract have that compounding effect? Yes or no? Then the answer is yes, sir. And how many times in a year it will have? It will have 2 times in a year. So that is how then we have to formulate this future price. Okay. So just to give you one more example, if suppose we are calculating your, let's say, 3-month future contract. Okay, so we are calculating 3-month future contract. If it's a 3-month future contract and the compounding is happening on, let's say, annual basis. So what will be the future price calculation formula? It will be spot into 1 plus I. That's it. There is no need for any raise to the power n. Okay, plus of course whatever is the storage cost, etc. Also at the same time, my dear students, if it is getting compounded on 6-monthly basis and it's a 3-month forward contract, will there be any power of compounding which will be applicable? Then the answer is absolutely no. So why? Because it's a 3-month contract and the first compounding takes place at the end of the 6 months. So that is why there is no need for any compounding which will happen. So the formula will be very simple. It will be again spot into 1 plus I plus whatever is the storage cost. Third, if it's a 3-month contract and if the compounding is happening quarterly basis, again there is no need to worry. We'll be simply taking futures is equal to spot into 1 plus I plus storage cost. But my dear students, if it's a 3-month contract and if the compounding happens on monthly basis, will the power of compounding come here? Come on, yes or no? Then the answer is absolutely yes. Now in this particular case, it will be future is equal to spot into 1 plus I, divide that by 12 because the number of compounding is happening for 12 times in a year. So divide that by 12 raised to the power n. Now n is 3 months. So we have to write down 3 divided by 12 and multiply that by whatever is this 12 times the compounding which happens. So ultimately raised to the power 3 plus the storage cost. So that is why the formula for this will now become futures is equal to spot into 1 plus I divided by 12 raised to the power 3. Because 3 times 3 is nothing but the number of times the compounding will happen in your 3 months contract. Okay. So this is something which, my dear students, I want you all to understand that in a 3-month contract, if the compounding happens annually, don't worry about anything. You know, just simple interest, no compounding effect will come. If, my dear students, if it is done on semi-annual basis, don't worry at all. It's a 3-month contract and the compounding happens on semi-annual basis. In your future price calculation, there is nothing to worry about because no power of compounding will come here. If it is on quarterly basis, my dear students, again, there is no need to worry. Why? Because it's a 3-month contract and the first time the compounding will happen at the end of the first quarter. No need to worry about it. And my dear students, if it is done on monthly basis, yes, in a 3-month contract, the compounding will happen for 3 times. So that is why it's raised to the power 3 and we have to divide by 12 and do that accordingly. Okay. But then also, my dear students, what about if it is a continuous compounded question? Now, when there is continuous compounded question, we use Euler's number, that is nothing but E. So whenever we are calculating a future price for a continuous compounded part, so your future will be nothing but spot into E raised to the power Rn. Always remember like this. So we have to take E raised to the power Rn and then we need to multiply, we need to add whatever is the storage cost to it. So basically, as you all know, let's say for example, your spot is 10 and your rate is, let's say for example, 12%, and we are calculating a 6-month contract. So it will be 0.12 into 6 divided by 12. So this plus whatever is the storage cost. And as you all are aware, my dear students, that this will be nothing but 10 into E is 2.7183, and this will be nothing but 0.12 into 6 divided by 12. So we have to divide that by half. So this will be 0.06 plus whatever is the storage cost. On this basis, can we calculate whatever is your future price? Come on, yes or no? Then the answer is absolutely yes. Okay. So my dear students, if it is continuous compounded, then we have to do this accordingly. So if you are pricing the futures, and if you're dealing with commodities, just you have to understand whether there is any continuous compounding or not. My dear students, if there is any continuous compounding, then make sure that we take E. So that is why the formula for that will become F is equal to spot into whatever is E raised to the power n plus storage cost. Okay. And on this basis, we can calculate your future price. Now, this is about commodities. Again, my dear students, this storage cost have the same implications, that if suppose if it is paid at the in middle of the year or at the beginning, then we have to definitely calculate the present value of the storage cost and deal with that accordingly. Okay. So this was regarding your commodities. Now, my dear students, let us quickly revise about your equities. So for your equities, my dear students, whenever we are calculating your future price, it is nothing but spot into 1 plus I raised to the power n. Then we have to definitely adjust your dividends. So my dear students, here it is assumed that if dividends is received at the end, then how do we subtract the dividends part? Because definitely there is not going to be any storage cost. So a buyer will always tell the seller, listen, that whenever we are actually taking into consideration the price of a future share, then the dividends which will be received by the seller, that will be treated as an income. So as in commodities, whatever the storage cost was there, we were adding it to the spot. Similarly, my dear students, whatever is the dividend income which is received by the seller, are we going to subtract the same? Come on, yes or no? Yes, sir. So dividends, we are going to definitely subtract it. Okay. So that is why that will be reduced from your spot. Similarly, my dear students, if your dividends are paid at the beginning, so when a seller is going to receive the dividends at the beginning, then your future will be what? It will be nothing but spot minus dividends into 1 plus I raised to the power n. And again, if the dividends are received somewhere in middle of the year, then what will be the formula for the same? It will be spot minus present value of dividends, my dear students, and into 1 plus I raised to the power n. So power of compounding, then it all depends on what is the contract tenure and what is the frequency of compounding. Whether the frequency of compounding will be applicable or not, that is something which you have to understand. Okay. And if it is continuous compounding, again, it will be spot, and I need to multiply this by E raised to the power n minus whatever is your dividend. So on this basis, we can actually calculate what can be the future price. Now, my dear students, after doing all these things, let us talk about index. So as I was telling you, in this entire chapter of derivatives, they will ask you how to calculate the price of the derivative contract. And there can be, my dear students, 3 types of the underlyings on the basis of which we can calculate the derivatives. The first type is nothing but your first part will be nothing but your commodities. The second part is your equities. Now the third part is nothing but your index. So now let's talk about your index. Okay. So index means what? As you all are aware, we are talking about now Nifty index or Sensex or Bankex, etc. Now in this particular case, whenever we are required to calculate the future price, so for calculating this future price, we have to definitely take whatever the spot price or the current price of an index, and to this we will be taking 1 plus whatever is your I minus dividend yield and raised to the power n. Okay. So always remember this, my dear students, that we have to take your interest from which we now have to subtract whatever is your dividend yields. Don't forget this, because whenever we are calculating the price of the future index, you always have to remember that the index can also earn dividends. Now, when the index is earning dividends, what do we do with this amount of the dividends, my dear students? So those dividend yields needs to be subtracted. Okay. So Nifty per se is not going to give you any dividend. But if suppose you create a replica portfolio of entire Nifty, will that Nifty actually, will that portfolio earn some dividends? Come on, yes or no? Yes, sir. So that is why this dividend yield, which will be in the form of percentage, do we need to subtract it? Yes or no? Yes, sir. So that is why while calculating the futures, we need to now take spot into 1 plus I minus dividends, and we have to then raise to the power n. Okay. Also, my dear students, futures is equal to, now in this particular case, it is not possible that dividend yield will always be in terms of percentage, my dear students. So it's not going to be calculated on present value terms because it's already in the form of a percentage. Okay. So that is why this will be simply your dividend yield. Okay. And then alternatively, let's say for example, if there is continuous compounding, so it will be spot into e raised to the power r minus d. Okay. Or we can also call this as I minus d because everywhere I've used I minus d. Okay, so and whatever is the tenure for the same, we have to take it into consideration. So that is why here the formula was usually e raised to the power rn. Then we used to take here also e raised to the power rn. So here also, my dear students, it is e raised to the power rn only, but this is r or I minus whatever is the dividends. We have to subtract it and then we need to multiply that by n. Okay, so on that basis, we'll be getting whatever is the future price. I hope, my dear students, you are able to understand this. So for index, my dear students, whenever we have to calculate the futures, it will be spot into e raised to the power I minus d into n. So that is how we calculate your future price. So this is how, my dear students, I have explained you in your derivatives, how can we price the future contracts for your commodities, for your stocks, and also for your index, for both, whether it is continuous compounded or whether it is normal. Okay, so for any one of the two, you can do the calculations by the way I've just now taught you. Okay, now, my dear students, after doing all these things, uh, let us now start with some of the practical problems, okay, to calculate the future price, right? So let us now start with your very first question, okay? Now we'll quickly revise these questions on your futures pricing. Let's read the first question. See guys, what is given to you? That spot price of Infosys is rupees 2000. So immediately you will be able to realize that for now to calculate a future price, we are now going to calculate the future price of an equity. Okay, so we have to look for now dividends. So we have in this particular question now the spot price of Infosys, which is 2000. So we have the spot available 2000. Interest rate prevailing is 14% per annum. Okay. Expected dividend after 2 months is rupees 10 per share. So this is expected dividend after 2 months. Okay, so we have to be very careful with this. Calculate what should be the expected price of Infosys today in the 3-month futures market. So now what is the contract tenure? The contract tenure is 3-month future contract. So for a 3-month future contract, now we need to calculate what should be the price today. So basically what we need to do is here in this particular case, we have to calculate a 3-month future contract. So it should be spot. And to this, we will be taking 1 plus I raised to the power whatever is your n. But here compounding will not appear. Why? Because they have not told you that this interest rate is getting compounded on monthly, semi-annually, quarterly. So if no information is given to you, then the interest rates are always compounded on annually basis. Okay. But it's a 3-month future contract and the compounding is annually. So the raised to the power n absolutely makes no sense here. Okay. So frequency of compounding will not be taken into consideration. And your expected dividend after 2 months is rupees 10 per share. Okay. So we have to subtract your dividend. Now, my dear students, unfortunately, here the dividend is not after 3 months. The dividend is after 2 months. So the first thing I need to do is, I have to first calculate what should be the present value of dividend. Because it's a 3-month future contract. I hope you have realized that for a 3-month future contract, if you are receiving the dividend at the end of 2 months, so first we calculate its present value and then we charge the interest for the entire 3 months, right? So that is why your 3-month future will be whatever is your spot. So what's your spot, my dear students? Your spot is 2000 into 1 plus what's your rate? Your rate is 14% per annum. So I'll take this 0.14 into sorry, before writing down this formula, first, before starting with the calculation, first let me write down the formula. Your 3-month future will be spot minus present value of dividends into 1 plus I raised to the power n. but here in this particular part, there will be no raised to the power n. So what's your spot? Your spot is nothing but, here you can check it's 2000. Also, what's your present value of dividends? So we need to calculate this present value of dividends, my dear students. So to calculate this present value of dividends, here I have, as you all can just check, it's a 2-month dividend which is the receipt. I have to bring that to the present value term. So how will I do that? So my dividend is rupees 2, is rupees 10. So I will now need to take 10 into 1 divided by 1 plus whatever is my discounting factor. Okay, that is I. Divide that by 12 into 2. Okay, because that rate of interest is on per annum basis, but we want to bring it into present value terms, and this dividends we are receiving at the end of the 2 months. So from 2 months we need to bring it to the present value. And how will we do that? So can I say I can simply take whatever is the interest rate, divide that by 12 into 2. So this will give me the effective interest rate just for the period of 2 months. So it will ease my calculations here. And again, there is no frequency of compounding which is applicable here. So this will be 10 into 1 plus 1 upon 1 plus, what's your rate? Your rate is 14%. So we will take 0.14, we'll divide this by 12, and then we'll multiply this by 2. So this will now give me 0.14, divide that by 12 into 2 plus 1. So this will now give me 10 into 1 upon 1.0233, right? So this will now be 1 divided by 1.0233, and to this, my dear students, I need to multiply this by 10. So eventually I'll be having this present value of 9.77. So because it's the first question, I'm just doing it very thoroughly. So this will now be 9.77. So I'll write down here 9.77, and then this will be 1 plus whatever is my rate. So what's my rate, my dear students? My rate is 14%. So this will be 0.14 divided by 12. But just be very careful. It's a 3-month contract. Hence, I'll multiply this by 3. Okay. So now let's do our calculation. So this will now be 0.14 divided by 12 into your 3 and plus 1. And then this I will take in my memory. And then I will take 2000 minus 9.77. And this entire thing I'll multiply it by 1.0355. So ultimately this comes as somewhere around rupees 2059.88 or approximately rupees 2060. So on this basis, we'll be getting your future price. Come on, yes or no? Yes, sir. So because it was a first question, I've done it, very thoroughly by taking each and every step into consideration, how to do the calculation from dividends, which was there at the end of your 2 months. We have to first bring that to the present value. So how will we do that? So we will take into consideration your present value, and then once we get the present value, my dear students, what we need to do, then from your spot we'll be subtracting the present value into 1 plus whatever is your rate, divide by 12 into 3. On this basis we'll be getting whatever is the 3-month future price. Okay, so though it's a revision lecture, but I hope you all have understood that the very first question we have done it thoroughly by solving it, and you all have understood this. Okay, now my dear students, continuing further, let us do the second question. For X, the spot rate is rupees 70, and now we have a continuous compounded rate which is nothing but 8%. We are required to calculate the price of a 3-month future expiry if the stock pays a dividend of rupee 1.5. Now my dear students, this particular question is also very easy to calculate. In your question number 2, here also there is spot rate which needs to, your future which needs to be calculated, and it's a 3-month expiry. So basically it's a 3-month future price which we need to calculate. Okay, and my dear students, here we have the spot. So spot into E raised to the power Rn or In, whatever. Okay, and what is your dividend per share? So if the stock pays a dividend of rupee 1.5, now it all depends that how are you going to treat this with 1.5. Will you treat this 1.5 at the beginning of the year, or at the middle of the year, or at the end of the year? So no information is given to you. Let us assume that the dividends were received at the end of the year. So we'll subtract this by dividend per share. So that is why whatever is your spot, what's your spot? Spot is 70. 70 into 2.7183 or your E. What is R? Your R is nothing but, my dear students, it's 8%. So we will take 0.08 and then we will multiply this by If it's a 3-month expiry, into 3 divided by 12. And what is your dividend per share? Your dividend per share is nothing but rupee 1.5. So then this is 1.5. So this will ideally help me to calculate what is going to be the final 3-month future price. So this will be 2.7183 raised to the power zero point 0.08 into 3 divided by 12. So this will give you 0.02. All right. And from this I'll subtract by 1.5. So as you all know, e raised to the power 0.02 is given to you as 1.02020. So simply, my dear students, 70 I'll multiply by 1.02020. And here I've assumed that the dividend is 1.5, which I'm receiving anyway at the end of the third month. So based on this, my dear students, we'll be taking into consideration what should be the price. Okay, so we will now take 70 into 1.02020, and from this if I subtract 1.5, I'll be getting 69.91. So what is this 69.91, my dear students? This is nothing but the price of a 3-month future contract if there is a continuous compounded rate. Okay, so here again I'm repeating, it is assumed that dividends is at the end of 3 months. If you want, you can also assume that the dividends are received at the beginning of the contract. So based on that, we can take spot minus dividend and then multiply that by E. But whatever you are doing, just make sure that you write down the assumption in your solution. Okay, if there is no clarity about it. Then let's start with the third question revision. Now this is where we are calculating how to find out the price of the futures, but this is in terms of an index. So whenever it's index, my dear students, I hope you all know that we will look for dividend yield. So let's read this, that stock index currently stands for 3,500. This is the spot. The risk-free rate is 8%, and your dividend yield on the index is nothing but 4%. Okay, and here they have told you what we are required to calculate a 4-month index future. So again, it's a very easy part to revise. Your question number 3, here we have to calculate what is going to be 4-month future. So 4-month future will be whatever is your spot into E raised to the power I or R whatever minus D into the tenure for the same. Okay, so what's your spot? Your spot is nothing but 3,500. So 3,500 is your spot into E raised to the power. What's your R? Your R is nothing but 8%, and the dividend yield is also for 4%. So this is always given to you on per annum basis. So now we'll be taking 0.08 minus 0.04, and then, my dear students, we'll multiplying this by your tenure. So what's your tenure, my dear students? Your tenure is a 4-month tenure. So we'll be taking 4 divided by 12. So this will now give me 3,500 into E. Now this will be 0.04 into 4, divide that by 12. So this will be 0.01333. Now there is no need to worry, my dear students, because this will be 3,500 and E raised to the power 0.133 is given to you in the question itself, and that is nothing but 1.0134. 1.0134. So will this help me to calculate what is going to be my future price? Come on, yes or no? Yes, sir. So this will be eventually coming as 3546.9. So this is how we are pricing the futures. Okay. So the first segment is only related to how do we price with it. And then we'll be dealing with the application of the future contracts, what is going to be the arbitrage possibilities, and all those things we'll be taking it into consideration. Okay. Now, my dear students, your next question, let us see what do we have here. Again, we have current price of cotton is rupees 400 per bale, that's a unit measurement, and the storage cost is rupees 100 per bale per year, which is payable in arrears. So now again, my dear students, are we required to calculate what should be the price of a commodity? Come on, yes or no? Yes, sir. And we have the interest rates of 10% CCRI. We are again required to calculate what is going to be the 1-year future price per bale cotton. So basically, again, here we are required to calculate a 12-month future price, and a 12-month future price can be calculated by taking spot into whatever is your 1 plus I raised to the power n, and to this, my dear students, I need to add what is going to be the storage cost, because they have told you that storage cost is payable towards the end. So that is why now this is storage cost payable at end. So what is the price? It is nothing but 400 rupees. That's your spot into 1 plus what's your I? Your I is 10%. But guys, this is continuous compounded, so this formula will not be used. It will be spot into E raised to the power Rn plus the storage cost. So again, this will be 400 into E raised to the power R. Your R is 10%, so it's 0.1. The tenure is 1 year, so there is no need to worry. And to this, my dear students, I'll be adding the storage cost. What's my storage cost? My storage cost is nothing but rupees 100. So this I'm going to add 100 to it. Okay. So my dear students, this will be 400 into, what is this e raised to the power? So this will be 1.1052, 1.1052, and to this we'll be adding 100 rupees. So will this give me my 12-month future? Yes or no? Yes. So 400 into 1.1052, and to this I'll be adding 100. So eventually this will be nothing but 542.08. So will this be a 12-month future price? Come on, yes or no? Yes, sir. Okay, so this is how, my dear students, we calculate the price of the commodity. So in the first 4 questions itself, you all learned how to calculate the future price of a stock, the future price of a commodity, the future price of an index. Let's check the next one. So your question number 5. Here also, my dear students, they have told you on 31st of July 2017, the value of the stock index is 2600. So this is nothing but your spot. Okay. So we have the spot, which is 2600, and then the risk-free rate is given to you as 9%. And the dividend yield on the stock index is as follows. Now, as you all can see, from January, February, March, every month the dividend yield is given to you. Now, this dividend yield is always on per annum basis. Okay, so always remember this, that dividend yield is always on per annum basis. So you must be wondering that for, sir, every month, how is it possible that the dividend yields are changing? So basically, when I'm talking about Jan month dividend yield, we are taking 12 months prior to Jan and calculating the dividend yield of the same. So let's say, for example, in that particular case, the spot might be, example, 10,000, and the total dividends for that 1 year might be 1,000. So that is why the dividend yield might come as 10%. But when we are talking about Feb, so it's possible that the spot can be, example, 15,000, and then my dividends can be, in this particular case, 3,000 for the last 12 months. So in this particular case, then my dividend yield here can be 20% also. So the dividend yields every month can be changed, but this is always on per annum basis. Okay, so always remember this. Your dividend yields is going to be on per annum basis. So we have per annum dividends. Okay. Now we are standing on 31st of July where the spot is 2600. Okay. The risk-free rate is actually your 9%. Okay. And assuming that the interest is continuously compounded, what will be the future price of the contract which is deliverable on 31st of December 2011? So we are required to calculate what should be the future price. Now, my dear students, when we are talking about the future price of the contract which is deliverable on 31st of December 2017, so we are standing on the last day of July. So we are talking from August perspective. So August, September, October, November, December. So for the period of 5 months, we are required to calculate the future contract. So how will we calculate this? So your 5 months future contract will be spot into E raised to the power R minus D multiplied by whatever is the tenure, right? So this will be spot. What's your spot? Spot. Your spot is nothing but 2600. This I need to multiply it by E raised to the power R. R is nothing but whatever is my interest rate, which turns out to be 9%, 0.09 minus what is my dividend yield. So now dividend yield, my dear students, I have to take from August to December. So August to December, my dear students, because we are talking from the July end perspective. So now we have 5 months dividend. So I cannot take summation of all the 5 because everything is on per annum basis. So what I need to do next is I'll be taking this and divide by 5. So I'll be taking the average of it. So 5 plus 2 plus 2 plus 5 plus 2, divide that by 5. So that turns out to be 3.2%. So this is your average, 3.2%, so 0.032. And this I need to multiply it by 5 divided by 12, right? So this is how I'll be calculating this. So this is 2600 into E raised to the power 0.09 minus 0.032 into 5 divided by 12. This will give you 0.02417. So my dear students, do I have this available? Yes. E raised to the power 0.02147. This will now give you 1.02446. So I need to now simply take 2600 and multiply this by 1.02446. So this will now eventually give me what is going to be my final answer, 1.02446. So this will eventually give me 2663.596 or approximately 60. So this is the 5-month future index price which I need to calculate it. Okay. So everywhere, my dear students, if you want to price the future contract, then this is how we will do it. Very easy to solve. Okay. You just have to be very, very, very thorough with what is your future spot, what is the frequency of compounding, what is the tenure of the contract, and all these things taken into consideration will definitely give you the final answer very thoroughly. Okay. Now, my dear students, continuing further. Okay, so these two questions, my dear students, are on arbitrage. So let's do this. Arbitrage between your futures and spot market. So basically, how do we calculate the value of a future contract? As just now I told you, you can calculate the value of the contract by taking futures is equal to spot into 1 plus I raised to the power n. So basically what we used to do normally, this is how we calculate the value of the future contract, right? Now, my dear students, that value which you have calculated is nothing but the theoretical value. What type of value it is, beta? It is nothing but a theoretical value. Now, this theoretical value, my dear students, we need to compare with the actual market price to check whether it is underpriced or overpriced. Okay, so this is something which is extremely important for you to understand. So whenever, my dear students, you are actually going to deal with your arbitrage opportunity, the first thing you all need to do is calculate what is the intrinsic value or what is the theoretical value of a future contract. Then, my dear students, this theoretical value, what we need to do, we have to compare that with the actual market price to check whether it is overpriced or underpriced. And this will help you to understand what is going to be the arbitrage profits which you can generate from the same. So now we are understanding how do we calculate the arbitrage profits between futures and spot. Okay, so this is something which we'll be understanding in this particular question. Okay, so see, before we start, let me give you an example. Let's say, for example, your spot is, let's say, 1,000 rupees. Okay, and I'm telling you to calculate a 12-month future price where I is, let's say, 10%. Okay. And also, now let's say the dividend per share is 0. Okay. And the compounding frequency is on annual basis. Now, based on this particular data, if I tell you that let us now calculate what should be a 12-month future price. So how will you calculate a 12-month future price? It is nothing but spot into 1 plus I raised to the power n. So your spot is 1,000 into 1 plus your I is 10% and raised to the power n. Now n is 1 year only, so there is no number of times the frequency of compounding will happen here because it's a 12-month contract and the compounding happens on annual basis. So there is no need to take any frequency of compounding here. Now in this particular case, if I ask you that what should be a 12-month future price, so you will tell me, sir, this should be 1100. Okay, very simple. Simply adding the interest rate to it. So you'll come to know that this is 1100. Now, my dear students, if I tell you that the actual price of the future, because futures are also financial contracts which are traded, and because they are traded on the exchange, it is very much possible that there can be a higher demand, and because of that, the price can be relatively higher. So let's say, for example, the price of the particular contract is higher. So if let's say it is 1200 rupees. Now in this particular case, if it is the price is actually 1200 rupees and 1100 rupees is nothing but your theoretical value. So can I say that your actual price is greater than whatever is the theoretical value or your intrinsic value? Come on, yes or no? Then the answer is yes. And if your actual price is greater than the theoretical value, what does it mean? That the derivative contract is overpriced. So it is overpriced. And whenever the things are overpriced, what do we do with the same? We definitely sell. We sell these overpriced contracts. And we sell the overpriced contracts and we will square it up in future. So first of all, if you want to really judge that whether your future contracts, what should you do with the same, whether we should add, whether we should buy or sell, the first thing you have to do is calculate the theoretical value and check with the actual price. Okay, so once again I'm repeating that if suppose the intrinsic value, intrinsic value, by the way, means what? The value which you are calculating as per the data given to you. So that is your intrinsic value. So whatever is your intrinsic value or your theoretical value, if you want to calculate intrinsic or theoretical value, then what do? you use this formulas, right? F is equal to spot into 1 plus I raised to the power n, and based on that you calculate whatever is the future price. Once you get the future price, what do you do with the same? We compare that with your actual market price, okay? Actual market price of the future contract, okay? Actual market price of the future contract. Now, my dear students, if theoretical price is greater, first part was, sorry, when the actual market price is greater. So actual market price is greater, then we will say that the contracts are overpriced. And my dear students, if it is overpriced, what do you do with the same? Then we will sell futures and buy spot. That's what you are going to do. And my dear students, if your intrinsic value is greater than your actual market price of the future contract, then what do we consider? We consider that it is underpriced and we will buy futures and enter into a short position in the spot market. So this is what we are going to do. So we need to first judge an arbitrage between future and the spot market, that what type, whether what is the theoretical value, what's the actual market price. So based on this, we will come to know whether we should buy or whether we should sell. So if it's an overpriced contract, what do? We'll sell futures and immediately take a buy position in the spot market. And if suppose the intrinsic value is greater than the actual market price, then it's underpriced. So we'll be buying futures. And then, my dear students, we'll be selling your spot. So this is something which we are going to do. This is something which we are going to do when we will be dealing with your future contracts. Okay. So now, first of all, okay, let us understand some steps, that what we need to do at day zero and what we need to do at the expiry. So always remember that this particular process is done by an arbitrator. Who is an arbitrator? An arbitrator is the person who exploits the market conditions. So whenever an arbitrator sees that, oh, the future price of the particular contract is greater than whatever is the theoretical value, then in that particular case, he will exploit this market condition. Now, he does not have any money available. So if he's selling futures and if he's buying the stock, he's buying the spot. Now, in this particular case, he will not have any money. So what he need to do is he have to take loans. And if he'll take loans, he have to pay interest as well. So all these things we have to take into consideration to generate the arbitrage profits. So to make you understand this in much better way, I want you to now come to your question number 6 first. The following data relates to your ABC's limited share price, where you have the current price per share is 180. So this is your spot. And price per share in futures for a 6-month contract is 195. So my dear students, this is nothing but your actual market price of the future contract. It is possible to borrow money in the market for security transaction at a rate of 12% per annum. So this is the interest rate which they have given you. We are required to calculate what should be the theoretical minimum price of a 6-month futures and explain if there is any arbitrage opportunity which exists. Now, very simple, my dear students. The first thing is, whenever you see such kind of a question, what we need to do is, we should calculate what's the future price. So how will you calculate the future price? So you will be like, okay, sir, it's a 6-month future price. So a 6-month future price, and have they given to you it's continuously compounded, something like that? No. So simply we'll be taking into consideration your spot into 1 plus I. There is no frequency of compounding. Why? Because it's anyway a 6-month contract. And if it's a 6-month contract and the interest is going to be done on annual basis, definitely the compounding frequency is on annual basis. So we are not going to take any frequency of compounding here. And from this, we usually subtract dividend per share, which is also not there in this particular question. Okay. Now, my dear students, what's your spot? Your spot. Can you see the current price per share is 180. So when I'm calculating my 6-month theoretical value, I'll take 180 into 1 plus. What's the rate? The rate is 12% per annum and it's a 6-month contract. So 0.12 into 6 divided by 12 and your dividend per share is 0. So in this particular case, this will now be 180 into 1 plus 0.06, right? So this will eventually give me my final answer, 1.06 into 180, which is nothing but 190.8. Now, this is my intrinsic value. This is my theoretical value. This is the value of a future contract. According to me, this should be the price of the future contract. But what I need to do is I need to compare that with the actual market price. And the actual market price, my dear students, is nothing but 195. Oh, so this is actual market price, which is 195. actual market price, that is 195. Okay, now you can say that the actual market price is greater, which ideally means what? That the futures are overpriced. And if the futures are overpriced, then what we need to do? If the futures are overpriced, what we need to do? Can I say we need to now undertake a sell position in the future contract, and then what we will do next, we'll have a buy position in the spot. So this is how we'll be earning an arbitrage profits. And arbitrage profits is very evident from here. It's nothing but the difference between intrinsic and the actual price. So now I will subtract this with 195 and I'll be now getting rupees 4.2. So will this be treated as your arbitrage gains, your arbitrage profits? Come on, yes or no? Yes, sir. Very easy. Okay. Now, how do we need to do the calculations of the same? So at day zero. So first of all, what's your strategy? Your strategy is that we will be sell futures and we will be buying shares in spot, right? This is what we're going. So we'll be selling futures and we'll be buying shares in the spot. So at day zero, what will you do? Day zero. So day zero, my dear students, your very simple concept in your day zero. First of all, the first point will be we will be. First of all, sell your futures. Okay, at what price? We'll be selling it at rupees 195, which is the actual market price. So there is not going to be any inflow or outflow for the same, obviously, because we are selling futures at rupees 195. There's not going to be any inflow or outflow for the same. The second part is, my dear students, now we will be definitely buying shares in spot at what price? So the price which is given to you is 180. So we'll be taking buy shares, we'll be taking a long position in your shares, okay, in the spot market at rupees 180. So there is an outflow of rupees 180. Okay. So eventually, my dear students, we have a net outflow of 180 at your day zero. So this is your net outflow, okay, of 180. Then also, my dear students, now at day 180, I think, because now we are six, it's a 6 month. So it's day 180, or let's say, for example, at the end of the 6 months, what are going to be the consequences? So first of all, we'll be squaring of the future. So square of futures at what price? So we'll be squaring this futures at 190.8. Sorry, at whatever is going to be the price at the end of your 6 months, right? So we'll be squaring it off at the end of the 6 months. Now, what is the price at the end of the 6 months? They have not given to you whether there is any price at the end of the 6 months or not. So let us assume that the price at the end of 6 months is, let's say, 300. Okay. So we are squaring it up at rupees 300. Now just imagine a situation. You sold the futures at 195 and now we are squaring it up at 300. So definitely you'll be thinking, okay, sir, we are incurring a loss of 105, right? So if we are squaring up the futures at 300, definitely there is a loss. And the loss is 105. Now this loss of 105 is always in cash settlement. Always remember that whenever we are dealing with a futures contract, so in futures, we are always and always dealing with your cash settlement. And what happens in the cash settlement is the inflow or outflow, whatever is a debit credit, that debit or credit will eventually be transferred to, it will be transferred to the brokers, to the client's account. So if it's a loss, it will be debited. If it's a profit, it will be credited, right? So here there is always cash settlement which happens. So let's say, for example, we are squaring the futures at rupees 300. So what is going to happen now? So from 300 minus 195, eventually there is an outflow of 105. So there is going to be an outflow of 105. Also at the same time, now it is mentioned that we are buying shares in spot for rupees 180. So what we need to do now, we need to sell shares. So sell shares at rupees 300. So I hope you all are aware about it, that let's say price on expiry of the spot is 300. So due to theory of convergence, the price of the future is also going to be 300, right? So it is something like this. See, let's say, for example, this is the spot, this is the future price. So let's say spot price is increasing. Okay. So future price, my dear students, towards the end will be nothing but equal to your spot price. Why does this happen? Is because I hope you all are aware about theory of convergence, where whatever is the future price on the expiry, it will be equal to your spot. So future will be equal to spot when? At the time of expiry. So in this particular case, we'll be selling the shares at 300. We are squaring up the futures at rupees 300. So there is an inflow of 300. Okay, but here we also have to pay some interest. So we will take into consideration your interest paid. Now we took a loan of 180, right? So we'll be taking loan of 180, and to this 180, I need to now multiply what is going to be the rate. My rate is 12%. So this will be 12%. Okay, and it's for 6 months, so into 6 divided by 12. Okay, because if future is actually a derivative contract, so basically there is no inflow or outflow which we consider theoretically when we are actually calculating arbitrage gain. But if you ask me practically, when you enter into future contracts, is there any margins which are involved? Then the answer is yes. Okay, but here while calculating arbitrage profits, when we are just selling the future contract, there is no inflow outflow which we take it into consideration. When we are squaring it up, yes, there will be profit or loss which will be debited or credited to my account. So I was a short seller here. I sold the futures, but now the prices increase, so I'm buying it. So there is a loss which I'm incurring because I sold at 195, I'm buying it at 300. So there is a loss of 105. But I had also purchased the shares for 180. I'm selling it for 300. So that's my inflow outflow. Now let's talk about my loan and interest paid. So my interest paid will be 180, and to this 180 I need to multiply it by 12% and into 6 divided by 12. So this will eventually give me 10.8. So 10.8 is nothing but my interest which I'm paying. Okay, so 10.8 is my interest rate. Now, is there any dividends which are given to you in the question? Then the answer is no. So let's just check this out. Is there any inflow which is available or not? So here there is 300 and here there is 105 plus 10.8, which will eventually give me 115.8. And from 115.8 minus 300 will actually give me 184.2. So 184.2 is my net inflow and 180 was my outflow. So as you all are aware that 184.2 minus 180 will eventually give me 4.2. Is this 4.2 my arbitrage gain? Come on, yes or no? Then the answer is absolutely yes. So we had determined this earlier only that my arbitrage gain is going to be 4.2. But this 4.2, my dear students, we have to take it into consideration by using this entire calculation which is there on your screen. I hope you all are also solving this, revising this very thoroughly with me. And practice is very important here. So the stages are very simple. We identified first what is going to be the theoretical value. What did we do next? We compared that with the actual price. The third step is we identified whether it is overpriced or underpriced. Then we understood, okay, if it's overpriced, what we need to do is we need to sell it. If it's underpriced, we need to buy it. And if it's overpriced, we are selling it. Just make it a point that we are selling futures, we'll be taking in spot the opposite position. Okay. And then also, my dear students, if it's an underpriced contract, then we'll be buying it and then we'll be selling it in spot, and then there will be interest received, which will be taking into consideration. But practically, this is not going to happen. So that is why we'll always see the questions in which there is overpricing of future contracts. So there is one more question regarding the same. So here I took the expiry of 300. You can take any damn expiry. You can take expiry of 300 or 250, or even if you can take expiry of 50 as well. So let's say, for example, if you're taking expiry of 100, okay, so the price on expiry is 100. So now at the end of 6 months, what will be the changes? The changes will be, you will be squaring futures, okay, you will be squaring futures at what price will be squaring up your futures. So now I'm taking the expiry of 100. So now, will there be an inflow or outflow? So mind you, my dear students, we were a short seller here. We sold the future contract at 195. Now we are squaring it up at 100 rupees. So is there any inflow? Come on, yes or no? Yes, sir. So there is an inflow of 95. Then, because there's a profit, right? Then we'll be selling shares. So sell shares at rupees 195. So there is an inflow of at rupees 100. So then there is going to be 100 rupees in, and of course there will be some interest paid, and the interest paid is going to be the same amount, which will be 10.8. So that's my outflow. So eventually this is 195, from which I'll be subtracting 10.8. So I'll be getting 195 minus 10.8, which will give me 184.2. So eventually, my dear student, this is 184.2. Again, the same thing where it was 184.2. So any damn expiry you will take, will you be getting 184.2 only as your net inflow at the end of the 6 months? Yes or no? Yes, sir. So this will help you to actually calculate what is going to be the arbitrage gain. Okay. So I've taken both the expiry and proved it to you that one expiry, if I'm taking more than 195, then what's happening, and one expiry if I'm taking less than 195, what's happening. In both the cases, it's going to be the same. Okay. Similar to this, my dear students, we have one more question which is going to be dealing with your arbitrage only. So I'll be quickly revising that as well. Calculate a 3-month PQR futures if PQR quotes 220 on NSE. And here they have told you that uh, on NSE, it's a 3-month future which is quoting at 230, and 1 month borrowing rate is given as 15%. Make this as a 3-month borrowing rate. Why? Because institute has also taken into consideration without compounding effect. And here they have considered as 3-month borrowing only. So there is no compounding which is given to you, because if it would have been 1 month borrowing, then definitely there can be a compounding implications for the same, because it's a 3-month contract and 1 month compounding. So definitely we have to take into consideration divide by 12. So your frequency of compounding will come here. But ICAI solved it without taking into consideration of your compounding. So that's why we are taking a 3-month compounding borrowing rate, which is 15% per annum, and the expected annual dividend is 25%, payable before expiry. Also examine the arbitrage opportunity. So my dear students, now you are very champion in calculating what should be the future price. So very quickly, I will show you the solution for the same, so it becomes easier for you. Your 3-month future price can be calculated like this. Okay. So this was your question number 6, and now we are revising question number 7. Okay, so theoretical price. So as you all can see, my dear students, do we have the spot price available? Come on, yes or no? Yes, sir. So we have the spot price. What's the spot price? Beta, the spot price is 220, and the actual market price of the futures is 230. So we have the spot price of 220. This is 230. The rate is 15% per annum. And also at the same time, the expected dividend is 25%. So 25% on the face value of 10. So that will give you 2.5. So let us calculate the theoretical value, which is spot into 1 plus I raised to the power n. From this, I need to subtract my dividend per share. So this is 220 into, the rate is 15%. So that's why we will take 0.15 into 3 divided by 12. And as you all know, here the dividend is paid towards the end. So nothing to worry. We'll be simply subtracting your dividend per share of 2.5, which will eventually give you 225.75. So this is my theoretical value. The actual market price is 230. This is 225.75. So this is overpriced. So hence your arbitrage will exist. Okay. And there will be arbitrage gain of 4.25. And very evidently, you all can see here, my dear students, that your actual market price is greater than the theoretical. When your actual market price is greater than the theoretical value, so we can say that the future contract price is overpriced. And if it is overpriced, my dear students, you all know what are the implications. The implications are very, 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 very simple, that we have to take into consideration. We have to take into consideration, if it is overpriced, we are going to sell the future contract and simultaneously sell the future contract. And what we have to do next, we have to buy it in the spot. So exactly what we have done here. Strategy: sell futures and buy shares in the spot. So we have price on expiry, which we are taking either 400 or 100. The same process, we are selling futures at 230. So ideally, there is not going to be any kind of inflow outflow in your future contract. So that's going to be 0. Then we'll be buying shares in the spot market. So that is going to be 220 of an outflow. So your day 0 outflow is 220, which is fixed. That is the price of the share. And then at your day 90, what is going to happen is that we'll be squaring up the future contract. So when we are squaring up the future contract, what will happen is that we'll be squaring it up at 400 rupees. So we had sold it for 230. Now we are squaring it up at 400. So definitely we are buying it at a much higher rate. So there is a loss. So because of there is an outflow of 170. So we are taking your outflow of 170, and we'll be selling the shares at 400, and your interest paid, that will be 220 into 15% to 3 divided by 12. And also there is dividend income, which we have to take into consideration here, which is 2.5. So because we were investor in the stocks, because we were having a long position in the stock, remember that, are you entitled for dividend income? Come on, yes or no? Yes, sir. So that dividend income of 2.5 is also going to come, which will eventually give you 224.25. So this is going to be your inflow. So whether you take into consideration your second part also, here it is going to be 224.25. So in both the cases, your arbitrage gain will be 4.25, which we had discussed earlier. So it's a very easy concept, that arbitrage gain can be calculated by taking any kind of expiry, and we are going to deal with the same. Okay. Now, my dear students, let us start with your question number 8. Now, this deals with your margins. So, what are actually margins? My dear students, whenever we want to enter into any kind of future contracts, you always have to understand that we have to keep some margins with the broker. Okay. So, ideally, what do I mean by this is, uh, let's say for example that we are taking into consideration what is going to be let's say for example we are taking into consideration what is going to be the margin for for entering into a future contract. So imagine a situation where let's say for example you are uh, let's say uh, you want to enter into a future contract, you want to buy a future contract. Okay. Now the contract value, let's say for example your contract value is, let's say, 5 lakh rupees. But when there is margins which is taken into consideration, my dear students, then are we going to pay 5 lakh rupees entirely to the broker? Then the answer is absolutely no. So we will not be paying 5 lakh rupees entirely to the broker. So here we have to pay some type of margins to the broker. Now, what are these margins? Now, let's say for example, uh, you know, your margins are, let's say, example, per lot. For example, you are paying a margin of, let's say, 2 lakh rupees. Okay. So in this particular case, the contract value is 5 lakhs, but you just have to pay rupees 2 lakhs. Pay in the sense you have to deposit this 2 lakh rupees with the broker, which actually allows you, to enter into a long position in this particular future contract. Okay. So my dear students, you have to understand this, that whenever there is a future contract which needs to be entered, here we have to deposit some type of margin with the broker. Okay. Which is not actually your contract value, some percentage, some part of it. Okay. So what will be the same? I will help you to understand this. But first of all, we just have to pay only the margin amount. Okay. Now, my dear students, on day-to-day basis, till the time the contract is expired or till the time you exit from the contract, there will be some fluctuating in the spot prices. So when the spot prices fluctuates, can I say that the future prices are also going to fluctuate? Come on, yes or yes, sir. So when the future prices are going to fluctuate, can I put it like this? There can be either a upward revision to the future price or a downward revision to the future price. So based on that, your margins needs to be adjusted. So this is called as mark to market margin. So always remember that whenever the margins needs to be adjusted, it has to be on the basis of MTM, mark to market. So on the closing prices, whatever is going to happen at the end of every day, do we have to adjust the margins? Come on, yes or no? Then the answer is yes, sir. So always remember this, that whatever margin we deposited with the broker, does this margin needs to be adjusted? Come on, yes or no? Then the answer is yes. It needs to be adjusted with whatever is the closing prices which are going to be there. Okay. So let me explain to you something like this. Let's say but there is a margin which is required for 1 lakh rupees. So I've entered into 1 lakh rupees. I've deposited the amount, in the margin. And now let's say, for example, I had purchased the share for 100 rupees. Okay. So this was the margin required and I've deposited the margin. Now, always remember, whenever you are dealing with a future contract, then this future contracts will always have some specific lot size. Okay, so let's say your one lot is, let's say for example, uh, you know, uh, let us say 10,000 shares. Okay, so your one lot is 10,000 shares. So total contract value is what? 10,000. You multiply this by 100. So it is 10 lakh rupees. So your contract value is 10 lakh rupees. But my dear students, this 10 lakh rupees is not supposed to be deposited with the broker. If you want to enter into a future contract, we just have to deposit the margin. The margin is what? 1 lakh rupees. Okay. So with this, I've purchased the shares at, let's say, for example, 100 rupees. Okay. Now, at the end of the day, suppose the market price becomes 102. So definitely there is some appreciation in the share price. Come on, yes or no? Yes, sir. So it is the future price, the future contract price has increased by 2%. Now, what will the broker do in this scenario? 2 rupees multiplied by what are the number of shares? So there is 10,000 shares. Okay, because this 2 rupees is per share. Multiplied that by 10,000 shares. How many lots have I purchased? I have purchased one lot. So total 20,000 rupees will be credited in my account. How much amount will be credited in my account? Better 20,000 rupees. So my dear students, now my margin account will look like 1 lakh plus 20,000. So ultimately, can I say 1 lakh 20,000 rupees? This will be treated as my margin at the end of day one. Come on, yes or no? Then the answer is yes. Okay. Let's say, for example, in the second scenario, from 102, now it becomes 105. So now there is an increase of what? 3 rupees. Then this 3 rupees, my dear students, is on per share basis. Multiply that by 10,000 shares. That is nothing but how many shares are there in one lot. Multiplied by the lots which I have purchased. I have just purchased one lot. So basically 30,000 rupees. So I had 1 lakh 20. Now 30,000 will be added to it. So will I be getting now closing margin as 1 lakh 50? Come on, yes or no? Yes, sir. Also, at the same time, my dear students, if there is any reduction in the price, then will that be affected in the margins as well? Come on, yes or no? Yes, sir. So let's say, for example, now from 105, the price becomes 104. So there is a reduction of 1 rupee. So this 1 rupee, my dear students, needs to be multiplied by 10,000 shares. So multiplied by one lot. So now 10,000 rupees is my loss. So broker will reduce that and it will be 1,40,000. I hope you guys are trying to understand. That is the margin going to change? Is the margin going to change? Yes or no? Then the answer is yes, sir. The margin is going to change. It will be marked to market, my dear students. It will always be marked to your market. Whatever is the market prices, based on that, your margins are definitely going to change. So this is something which I want you all to understand, that whenever we are dealing with margins, just make sure that we take into consideration your mark to mark margins, and on that basis we do the calculations. Okay, so this is now going to be 1,40,000. Now, my dear students, there is something which is called as your maintenance margin as well. Now, what is your maintenance margin? Maintenance margin is, my dear students, when your margin breaches a particular limit, then you will get a margin call. So what is the margin call? That broker will tell you, okay, please deposit the money in the margin account because your amount is falling below the maintenance margin. So apparently what happens is, let's say 1 lakh rupees is my initial margin. Okay. Now broker is not going to wait for the time that if there is a loss. So every year, if every day there is a loss, what will happen is that my margin will be getting reduced. Okay. So my margin available with the broker will be kept on reducing. So broker will not like that, because someday if suppose the prices fall drastically, then the entire margin will be blown up. So what does the broker do in such a situation is, the broker will always tell the client that now 1 lakh rupees is the margin. But if suppose your margin falls below, let's say 60,000, then you have to again refill your account. So you have to again deposit the money with us and bring the margin back to its initial margin. So now, my dear student, what's happening is that I have an initial margin of 1 lakh. But if it falls below 60,000, then let's say if it's 58,000 or it's 57,000, then the broker will give you a call and tell you, listen, now deposit that much amount till the time your margin becomes back to 1 lakh rupees. Okay. So not back to your maintenance margin, back to 1 lakh. Because if you just deposit 3,000 rupees, tomorrow again the stock prices will go down. So automatically your again the amount will be less than the maintenance margin. So again the broker has to give the call. So to avoid all these things, for your maintenance margin, the broker will always and always, tell you to deposit the money in such a way that you become equal to your initial margin. Okay. So always remember like this, my dear students, that whenever there is any maintenance margin, if your margin falls below your maintenance margin, then the margin call will be made to the extent that you deposit the money to the initial margin. What if there is an opposite situation? You keep on earning more and more profits, and because of that, your margin keeps on getting credited. So broker allows you to withdraw the money from margin account as well. Okay, because it's your profits. If you want, you can withdraw it as well, but only up to the extent that your money should not fall below initial margin. So they will allow you to withdraw the money, but at least that initial margin needs to be kept. So if suppose in my example, if 1,40,000 is the margin which is there, so if the client wants, can it withdraw 40,000 rupees from the broker's account? Come on, yes or no? Then the answer is yes, sir. but only up to the extent of initial margin. Okay, so you cannot withdraw full 1 lakh 40. Neither you can withdraw up to the extent of maintenance margin, because you never know, tomorrow the closing prices are lower. So what are the consequences? Again, the prices will be lower, so the maintenance margin will again come down. So broker allows you to withdraw the money, but that is only and only up to the extent of what? Up to the extent of their initial margin. That is something which you'll have to understand. Okay. So my dear students, always and always remember this, that there is something which is called as initial margin and versus your maintenance margin. So initial margin, my dear students, is always kept at the time of beginning, and whenever your amount exceeds initial margin, if you want to withdraw, you can withdraw up to the extent of initial margin. And whenever we are talking about maintenance margin, you can get a margin call from the broker up to the extent. You can get a margin call from the broker up to the extent uh, when your margin reduces below the maintenance margin. Okay, so you will get the call from the broker, and then the broker will tell you, okay, listen, you have to deposit the money in such a way that the amount becomes equal to your initial margin. So that is something which we have to take into consideration. Okay, so let's read this question, my dear students. Your question number 8. On November 15th, when the spot is 473, Mr. X buys 15 contracts of July Telco futures at 491. So this is your price at which we are buying the futures. And assume that the initial margin for Telco futures is rupees 800 per contract, and the maintenance margin is rupees 600 per contract. Given that each contract is 50 shares. So the first thing you have to understand is each contract or each lot has 50 units or 50 shares. Okay, and daily settlement is given to you, but now you are buying 15 contracts. So make sure that you are buying 15 lots. So for 15 lots, my dear students, how many shares are we buying? We have an exposure of 15 into 50, that is nothing but 750 shares. Okay, so this is your exposure, 750 shares. This is your exposure. Okay, now my dear students, you have an initial margin of 800 per contract. So what's your initial margin? 800 into 15, so that is 12,000 rupees. So my dear students, your initial margin is 12,000 rupees. And what's your maintenance margin? So your maintenance margin is 15 into 600, and that is nothing but 9,000 rupees. So that's your maintenance margin. Okay, so apparently, my dear students, if your amount is below your initial margin, if it's below your maintenance margin, then make sure that you are going to deposit the money in such a way that the amount becomes equal to your initial margin, right? So you'll get a margin call after that. Now daily settlement prices are given to you. So there is some withdrawal which has been done by Mr. X from his margin account, which is only once on November 16th. If he withdraws half of the maximum amount which is being allowed, compute the balance in the account at the end of each of these days and find profit or loss on 19th of November. So my dear students, what we need to do in this particular situation is that we have to see what is your profit losses. Okay, so in the first situation on 15th of November, the price when it becomes 496, the profit is 5 rupees. So 5 rupees, my dear students, multiplied by 750 shares, will be getting a total profit of 3750. So your margins have automatically increased from 12,000 to 15,750. On 16th of November, the price further increases. Wow. So there is a profit of 7 rupees. And this 7 rupees total profit will give you 5250. And my dear students, this 5250 plus 15750 will give you total of 21,000. But is also withdrawing half of the permissible limit. So what is the half of the permissible limit? Your initial margin is 12,000 and now your margin is 21,000. So are you having some excess? Yes, sir. We are having some excess of 9,000. So 9,000 half is 4,500. This much amount you can withdraw it. So from 21,000, if you withdraw 4,500, you'll be left with 16,500. Also, my dear students, then the prices becomes 488. So then there is a loss. Okay, so this is a perfect example of how stock market works, because you all can see that you were earning profits, and then eventually what happened, that one day there is a loss, and now you withdraw the money, and after that only there is a loss. So now again you have to deposit the money. Okay, so now there is a loss, and there is a loss of 11,250. So from 16,500, okay, then 11,250. So eventually you'll be getting 16,000 minus 11,250. So no, one second. How much was it? Okay, the amount withdrawn was 4,500. Okay, so half of the permissible limit, right? Hmm. Okay, so the amount becomes 11,250. So from 16,500, I have to now subtract 11,250. So this will be 5,250. Now 5,250 minus 12,000, this is the margin call of 6,750. So this is the amount, my dear students, which will be called by the broker. And then on it, because obviously we were on 16,500, then there is 11,250, there is a loss. So then eventually 5,250 is your balance. But then you'll receive a margin call to make sure that you deposit the money back to your 12,000 rupees. So margin call is of 6,750. And then on 18th of November, my dear students, again the price becomes 485. So there is 3 rupees loss. So this will be 2,250. And eventually this will be 9,750. And then on 19th of November, this price again rises to 491. So 6 rupees, 4,500. So this is 14,250. So eventually, my dear students, you will see that there is no profit, no loss in this particular question. Why? Because your profit and loss is going to be zero. Because your buying rate was 491 and your selling rate is also 491. Your closing rate is also 491. So there is no profit, no loss. So this 14 to 50, does it represent your profits? Then the answer is no. So it is nothing but the amount of credit or debit which you have done. So 12,000 was your opening balance. Deposits were this. Withdrawals is this. So closing balance is 14 to 50, which is your closing balance. So this is nothing but the actual amount you deposited or you withdrawn. So that is why it's going to be the same amount. Hence, my dear students, there is no profit, no loss. Okay. So we have to always check whatever is the buying rate and what is the closing rate. So it's very evident that your buying rate was 491 and your closing rate is also 491. So both the rates are same. So apparently there is no profit, no loss in this particular question. Okay. So this is what, my dear student, deals with your margins. Now let me explain to you, let me revise this entire concept of your hedging. Okay. So let us now do hedging with your future. So let us quickly start with what hedging is. Okay. Okay, my dear students. Now let us start with what is the basic meaning of hedging. See here, my dear students, you have to remember that hedging is the process of minimizing risk, which you all will agree. Okay, so whenever we are dealing with hedging, we are dealing with what? We are dealing with minimization of risk. So now you must be wondering, okay, sir, how do we minimize the risk of a portfolio? So let's say, for example, if I've invested in Reliance, Tata's, SBI, HDFC Bank, I've created a portfolio of it. Okay, now always remember that still this particular portfolio is exposed to the systematic risk, right? Because if there is any inflation, there is any political risk, etc., then in that particular case, the portfolio will definitely be having an impact. So it's very important, my dear students, for you to understand that we can minimize the risk of this particular portfolio by entering into a contract, by entering into a derivative, by taking an opposite position for the same. So I'm worried that what will happen to the Nifty? Let's say, for example, if the Nifty is going to fall and I'm long in my portfolio, then my portfolio will also fall, right? So to avoid this kind of a situation, what do I do is I actually enter into a derivative contract. So I will be now selling my Nifty futures to protect my particular portfolio. So hedging, by the way, means what? We have to minimize the risk. But how do you minimize the risk of your investments? You minimize the risk of your investments by entering into a short position or the opposite position in a derivative contract. Okay. So if I've invested in equity shares of 5 companies and I'm long by investing in a portfolio. But if I think that tomorrow, let's say for example, there is some uncertainty and because of which the value of the portfolio is going to fall. So then how should I hedge it? So I will sell my Nifty futures so that if the market falls, of course my portfolio is going to fall, but I will definitely earn some profits from this derivative contract. And whatever profits I'm going to earn from this derivative contract, that profits will be compensated for the loss here. So in that particular case, will my portfolio be hedged? Yes or no? Yes, sir. So always remember this, my dear students, that when you want to hedge a particular portfolio, what you do is you first of all see that what is your position in your cash market. Suppose your position in the cash market is long, then to hedge that, you have to see what is the derivative instrument which is available. Suppose that derivative instrument which is available is Nifty contract, Nifty futures, and if suppose you have a you have an option of shorting that Nifty futures, then you can short that Nifty futures. And if you short that Nifty futures, definitely if the market falls, whatever is the loss in that Nifty futures, that will be compensated by the profits. Whatever is the profits in the Nifty futures, that will compensate the loss in the particular portfolio. Okay. So to make you understand this, let's say for example, I have a portfolio. Okay. The total investment is 10 lakhs. Okay. And the beta of the portfolio to the market is 1. So what do I mean by this is the portfolio is exactly going to move how the market is going to move. So if the Nifty will increase by 1%, the portfolio will also increase by 1%. If the Nifty will fall by 1%, the portfolio will also fall by 1%. Okay. So my beta of the portfolio with the market is, let's say for example, 1. Okay. Now my dear students, let's talk about Nifty futures. Suppose Nifty futures is available and one contract value is, let's say for example, 1 lakh rupees. Okay. So value of one contract is 1 lakh. So immediately what will come to your mind? Okay, sir, if value of one contract is 1 lakh rupees and the entire portfolio value is 10 lakh rupees, and if I want to really hedge my portfolio by entering into a short position in the Nifty futures, then what do I need to do is I will short how many contracts? I will be shorting 10 contracts, my dear students. So here, as you all can see, my exposure value is 10 lakh rupees, okay, because that's my amount of the investments, and my hedge value is 10 lakh rupees, and I have one contract of 1 lakh rupees. So basically, if I want to hedge this entire portfolio with this one contract, what will I do? I will enter into a short position. So how will I enter into a short position, my dear students? I will be selling 10 contracts of Nifty. Okay, I'll be selling 10 contracts of Nifty. So my dear students, because value of one contract is 1 lakh rupees, so I'll be short selling 10 contracts of Nifty. So what is the strategy to hedge the portfolio? Strategy is I'm long in portfolio and now I will be entering into a short position in derivative market. So now you're wondering, sir, in this particular case, now what will happen? See, I'll tell you. In this case, let's say for example, the market, let's say for example, increases, or let's say your fear is you materialized and the market reduces by 5%. Now, when the Nifty reduces by 5%, can I put it like this? If the Nifty falls by 5%, then automatically your portfolio is also going to fall. So there is going to be loss in portfolio. So what will be the loss in portfolio? Guys, your portfolio value was 10 lakh rupees. Okay. So this 10 lakhs minus 5%, right? So 9 lakh 50,000. That will be the value of the portfolio. So here you are going to incur a loss of 50,000. Okay. Now just hold your breath. Now, what will be the profit here? Because see, you were short in your Nifty contract. So when you are short in the Nifty contract, so you have sold Nifty contract. Okay. And let's say, for example, Nifty was 10,000 rupees and there were 10 Nifties in one contract. So lot size was 10. That's how one derivative contract was 1 lakh rupees. So now from this 10,000 rupees which you have sold, you will have to now square it up. You have to square up. At what price? Because market is falling by 5%. It means Nifty is falling by 5%. So can I say this will now become 9,500? So eventually there is a profit here. Why do I use the word profit? Because I've sold it at a higher price and I'm squaring it up. I'm buying it up at a lower price. So definitely there is a profit of 500. Now this profit of 500, I need to multiply how many Nifties were there in one contract. So there were 10 Nifties. So I'll multiply that by 10. So there is 5,000 rupees. This is my profit per lot, profit per contract. And mind you, my dear students, we had actually taken into consideration 10 lots. So if this is 10 lots, can I say this is 50,000 rupees? So ultimately, this is the profit, this is the loss. So when the market falls by 5%, can I say that whatever was your loss in the portfolio of 50, that got compensated by profits in the derivative market of 50, eventually leading to no profit, no loss. So it's a perfect hedge situation. I hope you all have understood this. That on this particular basis, can you hedge your portfolio? Come on, yes or no? Yes, sir. So your portfolio gets hedged. It gets completely foolproof with whatever the market fluctuations are going to be. Now, of course, you must be wondering, okay, sir, what happens if the market is going to rise? Okay, if the market is going to rise, then obviously the value of the portfolio will also increase. Okay, but contrary to that, can I put it like this? That there will be profits in the cash market, but then there will be loss in the derivative market. It's okay even if there is a loss in the derivative market, because profits there will be compensated by the loss here. So ultimately, there will be no risk which will be attached. So this is something what we do, my dear students, when we are dealing with your future contracts, when we want to hedge this particular future contracts. Okay. So my dear students, this loss, profits, etc., which needs to be taken into consideration. Again, now if I continue this further, let's say in the same very example, if suppose the beta is 2. Now, if the beta is 2, my dear students, then automatically what will happen is my hedge value will now become 20 lakh rupees. Right? My hedge value will now become how much beta? It will now become 20 lakh rupees. Now, if my hedge value has increased, then automatically, my dear students, the number of contracts which I want to short, that will also increase. Come on, yes or no? Yes, sir. So that is why whenever you see a question on hedging, the first step is determine what's your exposure value. Your exposure value is nothing but how much investments which you are making. The second step is determine your hedge value. So what's your hedge value? Whatever is your exposure value, from this exposure value, my dear students, I multiply this by beta. What I get is my hedge value. Okay. And then, my dear students, the third part is we have to see what is the contract value. Okay. So value per contract, we are going to see that. Okay. So that is nothing but whatever is the price into number of units per contract. Okay. And then we have to calculate the total contract value. Okay. So ultimately, you will come to know that in our case, we will come to know whatever is the number of contracts which we want to hedge. So what we will do is, how will get the number of contracts which will be hedged? Whatever is the hedge value, divide that by the value per contract. So we'll be getting finally what are the number of contracts which we are going to select. Okay. So extremely easy for you to understand this. Okay. Now let us revise this question. Question number 9. Now Ram buys 10,000 shares of X at what price? At rupees 22, and obtains a complete hedge of shorting 400 nifties at rupees 1100 each. He closes out his position at the closing price of the next day, at which point the share price has dropped 2% and the Nifty futures has dropped 1.5%. What is the overall profit or loss of the said transaction? So first of all, let us see what is the exposure of Ram. Okay. So he has 10,000 shares of rupees 22 each. So can I say that his exposure value is 10,000 shares of rupees 22 each? That is 2,20,000. So that's his exposure value, right? What is the beta of the security? Now, there is no need for any beta here because they have given you what are the number of nifties which we are shorting. So there is 400 nifties which we are shorting at rupees 1100 each. Wow. So we already have the contract value, which is they have told you 400 nifty which we are shorting at rupees 1100 each. Okay. So basically what is happening is I am long here with 2,20,000 and I'm short here with 400 nifties into 1100 each. So that is 4,40,000. So here I'm short, here I'm long. Okay. Now, my dear students, what is happening is that the price of the share has dropped by 2%. So price of the share has dropped by 2%. So this price is dropping by 2%. So you will immediately say there is a loss here. Okay, no problem. What is the loss here? From 2,20,000, I'll subtract this by 2%. So this will give you 2,15,600. So there is no problem regarding the same. This is 2,15,600. And I'm shorting this 4,40,000. But this Nifty futures has dropped by 1.5%. So now I'll be squaring it up. Square up. At what price? So I'll take 400 and I'll multiply that by, I'll be squaring it up by 1100 minus 1.5%. So that is 1083.5. So this will now be 1083.5 multiplied by 400. So this will now be 4,33,400. So this is the profit. Okay, how much is the profit now? This was the sell, this is the buy. So the profit will be now 4,40,000 minus this, which will give you 6,600. So my dear students, what is the loss? So loss is from 2,20,000, it is 2,15,600. So the loss here is 2,20,000 minus 2,15,600. So that is 4,400 loss. And this gets compensated by a profit of 6,600. So ultimately, is there any net profit? Come on, yes or no? Yes, sir. So this will now give you the net profit of 2,200. I hope you guys are trying to understand. There will be a net profits of 2,200. So my dear students, that's how we are going to calculate your profit or loss over the overall transaction. So this was your question number 9. Now, what is your question number 10? We have BSE index. So we have the spot index available as 5,000. We also have the value of the portfolio, which is 10,10,000. Then, my dear students, we have the risk-free interest rate, which is 9% per annum. Dividend yield on index is 6% per annum, and beta of the portfolio is 1.5. Now, my dear students, we have the beta available. Okay. We assume that the future contract on BSE index with 4-month maturity is used to hedge the value of the portfolio over the next 3 months. One future contract is for delivery of 50 times index. Based on the above information, we are required to calculate what's the price. So first step is we are required to calculate the price. So how do you calculate the price, my dear students? So whenever we are talking about price, first of all, whenever we are talking about price, we can calculate the price by taking into consideration. Where is this question? Here. Okay. Price by taking into consideration your formula, which will be spot into 1 plus R minus D, right? So basically, what's the spot price of the index? Guys, the spot price of the index is 5,000, right? Also, at the same time, you all can just check into 1 plus what's your R. Your R is 9% and your dividend yield is 6%, and the contract is for the period of 4 months. So that is on that particular basis, we will come to know that the price of the future contract is nothing but 5050. So once we get the price of the future contract, which is 5050, the second part is what is going to be the gain. Okay. So first of all, we have to first understand that to calculate the gain, we are long in the portfolio, so we have to short in the index future. So our exposure value, which is the amount of investment, is 10,10,000. This I need to multiply it by beta. So I'll get my hedge value of 15,15,000. Now, my dear students, once I get the hedge value of 15,15,000, very easily I can find out what are the number of index futures to be sold. So hedge value, divide that by the value per contract. So this will now give you 15,15,000 divided by 2,52,500. Okay. So basically, these is nothing but 50 lots. I need to sell it. So per lot, 2,52,500. So 6 contracts are going to be taken into consideration. Okay. So 15,15,000 divide that by 2,52,500. So eventually I'll be getting 6 contracts. So we need to short at day 0 6 contracts or 300 indices. This is something which we need to sell it, and we are selling it at 5050. And what is happening now? You all can just check. They have told you that the gain on the short position of the index futures turns out to be 4,500. Now, this is something which is extremely important. I want you all to pay attention. My dear students, they have told you that the gain on short position of futures if the index turns out to be 4,500 in 3 months. My dear students, first of all, the basic thing you have to understand is it's a 4-month contract. It's a 4-month contract. And we are squaring up the contract at the end of the 3rd month. So basically, we need what should be the future price at the end of the 3rd month. So what we need is a 3-month future price. Now that is something which is not available to us. So you must be wondering, sir, we have this 4,500. No, but this 4,500 is the price of the index. That's the spot price. We actually need what should be the future price at the end of the 3rd. So for the first time, it's happening that we are squaring up the future contract before its expiry. So for that, do we need what should be the price of the future index? Yes or no? Then the answer is absolutely yes. So my dear students, always remember like this, that whenever we are squaring up a future contract before before its expiry, then we need to find out what should be the future price there. So how will you calculate the future price? So to calculate the future price, my dear students, we know that now only 1 month expiry is left. So that's why your future price at the end of the third month will now be 1 month future price. That will be spot into 1 plus here whatever is your I, because we are calculating index here. So that will be I, minus whatever is your dividend, and this into your time period will be 1 divided by 12. So this is how, my dear students, we have to calculate this future price. So you will see that you will get the future price of 4511.25. So this is the point where the students make maximum mistake. They take into consideration 4500 only for the purpose of buying Nifty. But I want you all to pay very, 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 very much careful attention here. Why? Because here you don't have, my dear students, what is the price. Okay, so this is a very important concept which I want you all to understand. Okay, so you'll always remember this, that whenever, my dear students, we are expiring the contract before, we are squaring up the contract before its expiry, we need the future price. And for the future price which we need, we can calculate the future price by taking this into consideration. Okay, so spot into 1 plus R minus D into 1 divided by 12. So this will be 4511.25. So this is how we are going to do the calculation. Okay. So what is the final answer? The final answer is, my dear students, we were actually selling the Nifty at 5050 and we are buying it at 4511.25. So this will actually give you a gain of 538.75, and there are 15 dices per lot. There are 6 lots. So this is the final gain which you are going to get. Okay. Now, my dear students, let's start with the next question. Question number 11. That's a very easy question. That which position we need to take, short or long position. So there's something which you can definitely do that. So not to worry. In your question number 12. See what is given to you in this particular question. A company is long on a 10 metric ton of copper at 474 per kg spot. So this is the spot price, and intends to remain the same for the ensuing quarter. The standard deviation of the change in spot with that of change in future is given to you as 6% and 4% respectively. And this is having a correlation coefficient of 0.75. Now, in this particular case, what is the hedge ratio? So your hedge ratio will be calculated by taking, which is nothing but beta, which will be taking by change in spot upon whatever is your change in futures, and this I need to multiply it by your coefficient correlation. Okay, so the number of times it happens, so that is your correlation coefficient 0.75. So my dear students, what is the change in spot? That is 4. You have to divide that by 6 and multiply that by 0.75. Ultimately your beta is coming as 0.5. Okay, so what is the amount of the copper futures which we need to sell? So for that, my dear students, first we need our exposure value. So we have our exposure value of, as I told you, this is 0.5. We have the exposure value of 474 into 10,000. So 10 metric tons is 10,000 kgs. 1 metric ton is 1,000 kgs. So your 10 metric tons is going to be 10,000 kgs. So that is how you will be getting the exposure value, which I need to multiply by beta. So this will give me my hedge value. So the total value of the contracts which I need to sell in the futures is nothing but 23,70,000. Okay, so that is the amount which we need to sell it. So again, the concept is the same, my dear students. We are actually long in copper and now we want to hedge this. So for that, we have to short sell copper futures. So for that, we need what is the value of the copper futures which we need to sell. And we know that the beta is 0.5. So our entire investment in the portfolio was 4,74,000. But I don't need to short 4,74,000 because my beta is 0.5. So that's why 23,70,000, that's going to be my hedge value. That is the total value of the contracts which I need to sell it. Okay. So that was your question number 12. Now, my dear students, question number 13. So in your question number 13, now this question involves many things. They have given to you a portfolio on 1st of April with 8 securities. We have the market price, we have the number of shares. So that will actually give you what is going to be the value of the investments, which will ultimately give you what is going to be the weights. Okay. And then we also have the beta value available. So weights into beta value. Can I say that will give you your weighted average beta? Come on, yes or no? Yes, sir. The cost of capital is 20% per annum, which is continuously compounded. So here there is E which has to be taken into consideration. And the investors fears a fall of prices. So when an investor fears the fall of prices, it means that he is expecting that the portfolio value will be reduced. So when the portfolio value is reduced, what can be done next? Can I say we can hedge the portfolio value? How? By entering into a short position, by entering into a short position in the derivative segment in your index futures. So the investor fears a fall and accordingly approaches, and you want to protect and the following is the data which is given to you. The current Nifty value is 8,500. The Nifty futures can be traded in 25 units only. And futures for May are currently quoted at 8,700. And the futures for June are quoted at 8,850. You are required to calculate the beta of his portfolio. So what will be the beta of the portfolio, my dear students? So beta of the portfolio is nothing but the weighted average beta, which turns out to be 1.102. Okay. Then, my dear students, we are required to calculate what should be the theoretical value of the future contract. So how do you calculate theoretical value or the intrinsic value? Because we are standing in May, in April, and the contract is going to expire in May. Our first theoretical value, for a 2-month future contract will be spot into 1 plus R minus D. Okay, and into whatever is the time period which we have to divide by 12. So this was on normal basis, but here because it's continuous compounded, it is spot into E R minus D into whatever is the time period, okay, for which the investment has been made. It's a 2-month future contract. So that is why we'll be taking into consideration here. We have the values of E also in the question. So 875.33. So this is the theoretical value. Also for a 3-month future contract, we have a theoretical value which is 8935.8. Now, my dear students, whether the theoretical value of the future contracts, now whether it is overpriced or not. So we have the actual prices also available. So I've just done some extra analysis. This is the theoretical value, and we are comparing that with your current market price. So we can come to know whether it is underpriced or not. So here in both the situations, my dear students, the contract is actually underpriced, and definitely we will prefer the investments which can be made. Okay. When, my dear students, what is given to you in the fourth part, what is the number of Nifty contracts that you would have to sell if it desires to hedge until June in the following cases? Is total portfolio. So if you want to hedge your total portfolio, so your value of the portfolio is 9,94,450, or beta of the portfolio is 1.1. So you will be getting the hedge portfolio, hedge value, that is 10,93,895. Okay. So obviously, my dear students, there will be a hedge value which will be 10,93,895. Now, my dear students, what is the value per contract? So this is 8850 into 25, that is 2,21,150. So if you want to, hedge your 100% of the portfolio, so that will be 10,93,895 divided by this. So that will be 5 contracts. If you want to hedge 50% of the portfolio, so that will be 10,93,895 into 50% divide by this. So that will give you 3 contracts. And if you want to hedge 120%, then you multiply that by 120%, divide that by 2,21,000. So this will give you eventually 6 contracts. Okay. So this is how we are going to taking into consideration this particular part. Okay. So this was an important question which you all can take it into consideration when you are replacing. Okay. Now, my dear students, let us consider the next segment which deals with your revision of beta of the portfolio. That if you want to revise the beta of the portfolio, then how will you do it? Okay. So very quickly, I'll revise this concept with the help of a question. First of all, whenever we are dealing with revision of a portfolio beta, okay, why do we first of all revise the beta of the portfolio? Okay, let us understand that. Suppose you are a fund manager, okay, you are a fund manager, and you think that, okay, sir, right now I am having a portfolio of 10 lakh rupees, okay, my portfolio is of 10 lakh rupees, and the beta of my portfolio is, let's say, for example, 2. The beta of the portfolio is 2, okay. And if beta of portfolio is 2, it means what? That if the market is going to increase by 2%, then my portfolio value will increase by 4%. And I'm very much sure that, let's say, for example, in next 3 months, the market is going to rise by 6%. Now, everyone wants to increase the value of the portfolio. So if the index is going to increase 6%, automatically you will tell me, yes sir, 6% into 2, it means 12%. 12% is going to be my rise, my increase in the portfolio, right? My increase in the value. But I still want to increase this 12%. How would I do this? So now you must be wondering, okay, sir, if I want to increase this, then I should increase the beta of the portfolio. The moment I increase the beta of the portfolio, if the Nifty increases by even 1%, my portfolio will be having maximum impact, right? So that is what we usually do. So in this particular case, my dear students, if I want to increase the beta of the portfolio, what will I do? I can introduce some assets in a portfolio which is actually having a higher beta, okay, which is having a higher beta. So let's say, for example, A, B, C. There are three securities in my portfolio, okay? And the weighted average of this is, let's say, for example, beta of the portfolio 2. And there is an investment of 10 lakhs. Now, my dear students, I want to now increase the portfolio beta further. So from 2, let's say I want to increase this portfolio beta to, let's say, 3 or whatever. I want to increase it more. So I will introduce now more security. Suppose I want to introduce D with an investment of 5 lakh rupees, and this particular security D has a beta of, let's say, 4. Okay, this security has a beta of 4. Now, what do you think will happen to the weighted average beta of the portfolio? Of course, it's going to rise. It will be more than 2. So how do you calculate the revised beta of portfolio? So revised beta of the portfolio will be what? It will be your existing investment of 10 lakh into 2 plus I am now further investing 5 lakhs whose beta is 4, and I will divide that by total investment of 10 lakh plus 5 lakhs, right? So this is what I do. So that's how I'll be calculating the final answer. So what will be my revised beta of the portfolio? This will be 20 lakh plus 2 lakh, divide that by 15 lakhs. So this will eventually give me 22 lakhs divide by 5, divide by 15, and ultimately, sorry, this will be 5 lakh into 4, that will be 20 lakhs. So ultimately, this will now be 40 lakhs, which I need to divide by 15. Eventually, this will give me 2.67. Did you just realize that the revised beta of the portfolio has increased? Come on, yes or no? Yes, sir. From 2, it has increased to 2.67. So ultimately, what has happened that the revised beta of the portfolio has increased, and you will definitely get more returns. So this is something which is going to be coming at your benefit, right? So there will be a revised beta of the portfolio which will be 2.67. So I can also now revise the beta of the portfolio by taking into consideration. Now listen to me very carefully. I'll be revising the beta of the portfolio by taking into consideration now, some more securities or some nifty contracts. I can now introduce nifty contracts also. Okay, so in my portfolio now, let me be long on nifty futures. So on that basis also the portfolio beta can be revised. Okay, so apparently what we can do here is, let's say for example, this revised beta of the portfolio we can also calculate by taking whatever is my existing investment, okay, into whatever is going to be my beta, existing beta, and to this, the fresh investments is nothing but the value of nifty contract, okay, which is required, okay, with its beta upon whatever is going to be my existing investment plus, guys, there is no additional investment when we are entering into a derivative contract. I hope you are all aware about this, because whenever we are investing in a derivative contract, you always know that in a derivative contract, my dear students, we don't make any investments, right? So your outflow is ideally zero. So there is going to be zero, which should be taken into consideration. So in this particular case, what will be the revised beta of the portfolio? So here, your revised beta of the portfolio, let's say for example, you want to keep it. Let's say you want to find out that. So existing investment is 10 lakh, beta is 2. The value of the future contract is, let's say, 5 lakhs, but it has only beta of 1. Okay, because Nifty's beta with its own self will always and always be 1. And this is something which I'll be dividing it by the existing investment. So my existing investment will be 10 lakh. Why existing? Because Nifty future contracts will never be part of the portfolio. It's a derivative instrument, right? So it does not involve any further outflow. So that's why it's always going to be 0. Okay. So that is why finally you can get the revised beta of the portfolio, and that will be 10 lakh into 2. Okay. That is 20 lakh plus 5 lakh upon 10 lakh. So this will now eventually give me 25 lakh divided by 10 lakh. So that is 2.5. So is 2.5 my revised beta? Come on, yes or no? Yes, sir. If I want, I can also do alternatively. If I have revised beta available as 2.5, and if they ask you in the question, what is the value of the Nifty contracts, you should take it into consideration. So that is also possible. And that is something what you can do by taking 10 lakhs into 2 plus x into 1. And this is something I can divide that by 10 lakhs. So now this will give you the final answer x 5 lakhs. So these are the Nifty of contracts which you should buy to bring your revised beta of the portfolio to 2.5. So sometimes they can ask you questions, something like this as well. So both the things are possible, my dear students. Okay. Now let's read this question number 16. So see, eventually you all must have also learned it like this, that whatever is your revised beta of portfolio, from this if you subtract existing beta of portfolio, okay, and multiply this by the existing value of investments, what we actually get is the value of Nifty contracts which we want to enter into. So basically, for example, your revised beta of the portfolio is 2.5, which you want. Existing beta of the portfolio is 2, right? And the value of the investments existing is 10 lakhs. So what is the value of Nifty contracts which you have to buy? 0.5 into 10 lakh, which is nothing but 5 lakhs. Exactly equal to what we had discussed. Okay. The same derivation. What we, from here only we can get it, the exact answer, which will be nothing but your 5 lakh rupees. Okay. So question number 16, this is the last question. Okay. What is given to you? The high net worth individual is holding the portfolio in rupees in crores. We have investment in diversified equity shares, and then we also have cash and bank balance, and we have the total amount. The beta of the portfolio is 0.8 and the index future is selling at 5,500 level. So that is the spot. And the HNI wants to increase the beta of the portfolio, but for it believes that the market would be up from the current level. How many index futures you should buy for the beta to be increased to 1.2? Now in this particular case, my dear students, you have the revised beta amount which is 1.2 and existing beta is 0.8. So 1.2 minus 0.8. Can I say there is 0.4 increase and multiplied that by what is the investment in diversified equity shares? 80. Because cash bank, we will not consider that as the part of the portfolio, because cash bank, my dear students, will never be forming part of your portfolio. They have told you that the beta of the portfolio is 0.8, which is dealing with your investment in equity shares. So from 80, if I multiply this by 0.4, ultimately I'll be getting 32 crores. So 32 crores, my dear students, this is nothing but the value of the Nifty future contracts, which you should ideally be, long in. Okay, so they have just asked you that the HNI wants to increase the beta, and he would believe that how many index features he should buy. So basically 32 crores is the total value of the contract, and let us check the value of one contract here. So what is the value of the one contract? As you all can see, the value of the one contract here will be ideally nothing but, you all can just check, Nifty is trading at 5,500 and one index futures is 100 units. So what is the value of one contract? One contract now, my dear students, will be 5,500 into 100. So that will be 5,500 into 100. That will be 5,50,000. So now I need to take 32 crores and divide that by, this is 32 crores, which I need to divide it by, this will be 5,50,000. So ultimately we'll be left with 581.82 contracts. So these are the number of contracts which you should buy. Around 582 contracts you should buy. So whenever there is revision in the beta of the portfolio, what is the conclusion? Take whatever is the revised beta. From that, what do you subtract? Whatever is your existing beta, then the difference you multiply that by existing value of the investment. So you'll come to know what is the value of the Nifty contracts you have to trade in. Okay, so that is the conclusion. Okay, so there are some more questions of the similar type if you want to practice 14th and 15th. You all can find this in the institute's material also, and you all can practice it, but the concept remains the same. So with this, my dear students, now I have completed the entire revision of the futures part. and all the transactions regarding the same. Now, my dear students, in the next lecture, we'll be starting with the revision of the options part. I hope you all have understood and enjoyed this entire revision series. If yes, please do share it with your friends, like and subscribe, and do comment on the video as well. That's it. Bye, guys. Take care. See you. Bye.